Most people think investors lose money because markets crash, because stocks fall, because something unexpected happens. But that's not the full story. Most investors don't lose money when markets go down. They lose money because of what they do after, and that's what this video is about. The market offers returns over years, over decades. But many investors never actually collect them because they don't stay invested long enough. They give those returns back. To understand why, think about how investing actually works. Markets go up over time, but not in a straight line. Prices move up, they fall, they recover. It's like hiking up a mountain. The destination is higher ground, but the path twists. It goes down sometimes, then up again. And sometimes you stop. You enjoy the view. You look around. You watch animals in the distance. Maybe you sit down for a moment, have a picnic, catch your breath. It's not always about moving upward. And investing works the same way. Progress doesn't mean constant gains. What matters is that you don't turn around just because the path isn't pointing straight up. And the most important part often comes after the hardest stretch. The biggest gains often happen shortly after the worst periods. Like building muscle. The stress comes first. The damage comes first. The growth happens after. Markets recover the same way. The pain comes before the progress. And that's exactly when most people aren't there. They sell after losses. Not because it was part of the plan, but because it feels safer. Like being on a ship in a storm. Waves are crashing. The deck is shaking. Some people panic and jump into the water. Not because the ship has sunk, but because staying feels unbearable. In markets, crashes feel the same way. The urge to escape feels stronger than the facts, so people step aside. They wait. They wait for certainty. They wait for things to feel safe again. And then, when things finally look calm again, when headlines turn positive, when it feels comfortable, they buy back in at higher prices. That difference between selling low and buying high isn't bad luck. It's behavior. The market didn't take that money. The investor handed it back. This happens over and over again, not because people are stupid, but because investing constantly puts you in conflict with your instincts. Your brain is designed to avoid danger. Losses feel threatening. Uncertainty feels wrong. And in real life, that instinct is useful. Thousands of years ago, that instinct meant survival. Imagine a hunter on the savannah. In front of him, a deer, food, opportunity, a clear reward. But somewhere nearby, a saber-toothed tiger. Real danger. That instinct saved his life. But markets are different. There is no tiger. Volatility feels dangerous, but it usually isn't. And that's why, in investing, this instinct often does the opposite of what we need. It pushes us away from the moments that matter most. That's why two investors can own the same assets and still get completely different results. One reacts, the other doesn't. One tries to feel safe, the other sticks to the plan. Over time, the gap grows, not because one was smarter, but because one interfered less. Investing isn't just about earning returns. It's also about keeping them. Imagine trying to fill a bucket with holes in it. You can pour more water in. You can pour faster. You can try harder. But as long as the bucket has holes, it never fills up. That's what overreacting does. Every panic sale, every emotional decision, every unnecessary move. It pokes another hole in the bucket. Most investors don't lose money. They give it back. And the simplest way to keep more of it is often to do less. If this helped you think more clearly about investing, that's all this channel is trying to do. No hype, no shortcuts, just ideas that hold up over time. If you found this useful, feel free to leave a like. And if you want more of this kind of thinking, you can subscribe. Let's see what compounds faster, the portfolio or the channel. See you in the next one.